Greetings, broker friends. Here to talk today about financial statements and net worth. Understand that these are not just paperwork. These are proving that your business is built to last. Okay? I need you to understand that whether you're expanding into new states, whether you're getting your first license, or whether you're simply maintaining your current licenses, regulators do in fact rely on these financial statements to assess the health and compliance of your company. These numbers are telling a story to them. So the real question I have for you is, are they telling the right one? My name is Jim Bell. I'm with MSource Training and Consulting. We help brokers get licensed and then ultimately help you keep it. So our job is to help you understand the myriad of regulations and requirements to get licensed and then to stay compliant and ultimately survive a state examination and make yourself a profitable business. If you need help with any of those things, please reach out to me. You can reach out at msource24.com or 248-230-9717. We are always here to help. Okay, that being said, let's get into the heart of what we came here for, which is to talk about financial statements. A couple key things I want everyone to understand. Financial statements, as state regulators are looking for them, incorporate two, and in some cases, three primary things. One is a profit and loss statement. Two is a balance sheet. The third, and some states are more picky about this than others, is what they call a statement of cash flows. We're going to focus today on the first two, which is the balance sheet and the profit and loss statement. We're going to talk a little bit about some of the common issues that we see coming up during state examinations or during licensing processes with the financial statements that are being presented. Okay. So let's step back and talk about what is a balance sheet. Balance sheet is designed to demonstrate to anybody reviewing it what are the assets of the company, what are the liabilities or expenses of the company as of right now, and ultimately what is the owner's equity. The three primary components are assets, equity, and liabilities. When you add equity and liabilities together, they should match in balance to the assets. Very important that you understand that, because that's how these regulators are determining your net worth for compliance with state requirements. Is they're going to take your total assets, they're going to subtract your liabilities. That's the number they're going to come up with for net worth. Don't make the mistake of looking at the ultimate bottom line on your financials and thinking you're good, because you may be looking at what's balancing to the assets, but you're not removing the liabilities to determine what is your actual net worth. Okay? The profit and loss statement. Profit and loss is going to be how much revenue have you generated, what were your expenses for that time period, and ultimately at the end of the day, how much of it came out the bottom as income for you. Okay? Let's talk a little bit about time periods. So the last date of your profit and loss statement should be the same date as your balance sheet. So if I told you that you needed year-end financials, that means a profit and loss from January 1st through December 31st and a balance sheet from December 31st. So the profit and loss is going to cover a period of time. The balance sheet will be a snapshot of a particular day. Okay? So just to reiterate that one more time. The profit and loss statement, the last day of that period that's covered will be the day that your balance sheet should be from. Okay? All right, so now we've covered the basics on what the statements really are and what we're looking for. Let's talk about some of the common issues we see. Number one, balance sheets that don't balance. You can't have it where your assets do not equal your liabilities plus your equity. If they don't balance from top to bottom, you have something wrong in there. Okay, so very important that you're looking at those numbers. When you look at the equity section, in many cases, the way that the profit and loss will be designed is it's also going to carry over the net income from your profit and loss statement. We want to make sure that we're all clear on that those numbers have to be the same, right? So if I tell you I have a profit and loss statement from 2024 with a net income of $20,000, when I come over to the balance sheet and look at the equity section, if that net income doesn't say $20,000, I have a problem. because those things don't synchronize to each other, and therefore they don't represent accurate financial statements to a regulator or anybody else who's reviewing that information. Okay? So those are some key things to think about and take away. The other is what I would tell you is going a little bit deeper into this, and I don't want to go too deep, but understand that some assets will be backed out as non-allowable assets towards your net worth. Kind of think about this as, when we look at self-employed income, sometimes there are things we can add back. Sometimes there are things that we have to take away, like, mortgages and notes payable in less than a year have to be removed from that borrower's income. The same thing applies with certain things on your balance sheet. When we're reviewing a balance sheet, if I see that I have loans from shareholders, right, or loans from the owner as part of my assets, I have a red flag, and most regulators are going to remove those dollars because they're going to consider those from an unacceptable source to be considered an asset. Okay? I know in a lot of cases this is the way that CPAs are requiring you to do that. There are definitely tax ramifications both directions. I'm not your CPA. I'm just letting you know what the regulator is going to see when they take a look at your financials to determine compliance with net worth requirements. Okay? So the other thing I want to bring up in this case is, what are the acceptable assets associated with the company, as well as the liabilities. So first and foremost, understand, unless you are a sole proprietor, only the assets of the actual business can be factored into your balance sheet and your profit and loss. So that means 401ks, equity in your home, cars, other things that you're considering in terms of assets. Only if they're titled in the name of the business can they be used towards your assets for net worth calculations. All right. So if you're planning on using a vehicle, or maybe you have some rental properties and they're free and clear, or even if they're liened, you have equity in them. If you intend to use those as assets, they need to be titled in the name of the business. They can't be personally held assets. Okay? All right, let's also just talk now a little bit more about net worth specifically. This is a common issue that comes up when we're reviewing this with clients, and we've seen significant issues. When your state has a net worth requirement, very important that you understand that means you're supposed to be maintaining that net worth from beginning to end at all times. So if you're in a state where, let's say California wants you to be maintaining as a mortgage broker a $50,000 net worth at all times. That means technically if you fall down to $45,000 in assets throughout, net worth throughout the year, technically you're in violation of your license. So I want everybody to understand, you can't just put the money into an account, run the financial statement, get your license, and then yank all the money back out of the account until it's time to do another financial statement. We have seen many occasions where state examiners will come back and say, okay, show me your asset statements for the last 12 months. Some states like North Carolina will make you submit a statement from your financial statement or financial company, like your bank, that says you kept X number of dollars in this account at all times during the year. So understand what those requirements are. Understand that they have to be met at all times. Okay. I think this covers the bulk of what we see, but it's very, very important. One last note, and I get this question quite often. When you go into your NMLS account for the company, you will see two different entries on the bottom left corner for when things are due. One is what's called the MCR-annual, also referred to as the Statement of Financial Condition. The other is the actual financial statement component. I need everybody to understand these two things are actually different. Although you'll use your financial statements to prepare the annual financial statement of condition, which it is directly based on those documents, that is a report that is required to be filed by all companies Whether it's quarterly or annually depends on whether or not you are a broker or a lender. But that report is required. At minimum, that has to be filed within 90 days of the end of your fiscal year. Financial statement requirements are separate. Not every state has a financial statement requirement. For example, Colorado does not have a financial statement requirement. That means that each year, you're not required to upload your financial statements into an MLS. If you have a financial statement requirement, that's where you're going to upload it. You're going to go under your filings. You're going to go ahead and select financial statements, and you will upload your appropriate financial statement there. The annual SFC or the quarterly financials for lenders will be based on those documents, but they're not. That's a report specifically. It's not the actual financials. It's just taking those financials and putting it into NMLS's version of the financial statements. Okay, hope that's clear. Sorry if this got a little bit longer than I expected, but again, we're here to help. If you have any questions on financial statements or net worth, or you have concerns about it, please reach out. Again, MSource24.com. Happy to help in any way we can. Thanks. Make it a great day.